Hello, my name is Crystal. I'm a senior at MCLA, majoring in business administration with a focus in accounting. My research is part of the Massachusetts Commonwealth Honors Scholar Program and is focused on the convergence of the United States-based generally accepted accounting principles and international financial reporting standards for financial accounting. Today we will be covering multiple different aspects of financial accounting. In order to fully understand the impact of convergence on accounting standards, it is crucial to first understand the development and progression of accounting over time and how the existing standards were created and enforced. My research specifically dove into the convergence concepts of fair value and revenue recognition. Taking an interdisciplinary approach, I further looked into the social impact of convergence on consumers and investors to determine how the phenomenon would influence for capital allocation decisions. When trying to understand what financial reporting is, it is important to always remember that the overall objective of financial reporting on the aggregate level is to provide decision-useful information to external users for decision-making purposes. This information is communicated through multiple avenues, including financial statements, quarterly and annual reports, press releases, auditors' reports, and more. When financial statements are in accordance with a standard set of regulations, reliable financial statements are the building blocks for establishing investor confidence in businesses, which ultimately leads to increased economic activity in both global and domestic markets. Before generally accepted accounting principles and international financial reporting standards existed, there was no standard set of rules for preparing financial statements. The history of accounting begins with the Industrial Revolution during the early 19th century, when England started to undergo economic expansion and become the epicenter of global trade. Textile mills were high on the rise, and allocation of overhead costs became a looming issue as accountants grappled with how to account for the cost of operating the textile mills. The next major movement for the accounting industry was the Revenue Act that Congress passed in 1913. The act established a federal income tax of 1% on income over $3,000 and 7% of income over $500,000. The new tax law increased demand for tax accountants and kick-started accounting as a professional discipline in the United States just in time for the implication of World War I. The onset of World War I initiated a need for accountants to act as purchasing agents and to begin introducing inventory accounting to keep track of all of the goods that were leaving production sites. Towards the end of the World War, many of the weapon-producing companies chose to merge with others in their industry, which sparked a merger and acquisition process in the accounting industry. Following World War I, the Great Depression had significant impacts on the accounting profession. The stock market crash of 1929 raised red flags for the accounting industry regarding the presentation of financial statements and exposed financial fraud. The crash created a lack of consumer confidence due to consumers not being able to rely on financial statements produced by the organizations. As a result, there was increased government intervention, which established the Securities Act of 1933, the Glass-Steagall Act of 1933, the Securities and Exchange Act of 1934. All of these acts were intended to create oversight and regulation of the accounting industry to prohibit deceit and misrepresentation of financial information. The birth of the United States accounting regulation began in 1936, when the American Accounting Association was the first group to make an attempt at creating a conceptual framework. The group put together the Tentative Statement of Accounting Principles, which provided the SEC with authoritative guidance for establishing corporate accounting standards. In 1938, the American Institute of Accountants released a report titled Statement of Accounting Principles that specifically addressed proper formatting of the income statement, balance sheet, and statement of cash flows. In 1939, the American Institute of Accountants organized a subcommittee of accounting procedures who were tasked with researching and issuing accounting research bulletins. During 1940, many companies were practicing different accounting methods for various issues, including deferred tax accounting, historical cost versus current value, price adjustments, and profit and loss statements. In 1958, the AICPA created the Accounting Principles Board, whose primary focus was to advance written accounting principles and determine appropriate accounting practices while issuing opinions on emerging issues in the industry. In 1973, the FASB, Financial Accounting Standards Board, was appointed as the primary rule-setting body for accounting standards. The FASB tasked themselves with the responsibility of creating a formal conceptual framework for financial reporting, which is still used in practice today. The birth of international accounting regulation mostly began in 1950 to 1960 with new growth in foreign trade. Europe implemented the international study group to compare and contrast the accounting methods throughout various countries. This group recognized the discrepancies in accounting standards and the incomparability of financial statements across companies. In 1973, accountants from Australia, Canada, France, Germany, Japan, Mexico, the Netherlands, the UK, Ireland, and the United States created the International Accounting Standards Committee to achieve the first formal set of international standards. In 1983, the International Accounting Standards Committee developed the Organization of Securities Commission to assist in the oversight of implementation of international accounting standards. The Commission helped develop standards, improved information exchange, and implemented appropriate accounting regulation. In 2001, the SEC asked for a restructuring of the International Accounting Standards Committee to match the organization of the FASB. As a result, the committee appointed the International Accounting Standards Board, who were the first group to begin discussions of convergence of GAAP and IFRS. When understanding financial reporting, it's important to understand a breakdown of the conceptual framework. The first level of the conceptual framework is the objective of financial reporting. The second level is qualitative characteristics of accounting information that are used to determine if a piece of financial information will be useful. I'll get more into that in the next slide. The third level guides how organizations should recognize, measure, and disclose financial information to external users for decision-making purposes. The Level 2 hierarchy of accounting qualities shows multiple different qualities of accounting that external users can use in their decision-making purposes regarding capital allocation. The first few accounting qualities are the pervasive criterion, which is the information decision useful? The overall goal of accounting or financial reporting is to put out information that is decision useful for investors to make decisions with. The two fundamental qualities of accounting are relevance and faithful representation. The concepts of the fundamental qualities are predictive value, meaning that the information can help users predict different circumstances coming up in the company. Confirmatory value will help users confirm their predictions that they make. Materiality is whether or not the information has a material impact on the decision the consumer is making. Completeness refers to if the financial information is complete and fully displayed correctly. Neutrality shows that the information is free of bias, and free from error shows that there are no accounting errors in the process. Enhancing qualities are comparability, verifiability, timeliness, and understandability, and these qualities just further help users understand if their information they're looking at is relevant and useful to their decision-making process. Some of the convergence progress that has been made to date and completed by the FASB and the IASB is shared-based payments, segment reporting, non-monetary assets, inventory accounting, accounting changes, borrowing costs, research costs, and non-controlling interests. All of these projects were established by the FASB and IASB in the beginning of the Convergence project, and they were able to achieve them in a timely manner. The projects that still remain in progress or are pending completion are fair value measurement and revenue recognition, of which I'll get to in just a minute, and impairment and government grants, which the FASB and the IASB has willingly chose to put off impairment and government grants until a later date, until they can address more pressing issues such as fair value measurement and revenue recognition and financial reporting. As the FASB and IASB continue to work towards a more compatible set of accounting standards for domestic and international reporting purposes, U.S.-based companies are finding it challenging to adjust their field practices to accommodate the new standards. The reason for this is because GAAP is primarily rules-based, whereas IFRS is primarily principles-based. We see this issue become prevalent in Accounting Standards Topic 820 and 606, which address fair value measurement and revenue from contracts with customers. The difference between historical cost and valuing assets at their original price refers to fair value being the current market cost of what an asset is, and the historical cost is the original price of what the company paid for the asset. The new guidance provides a fair value hierarchy to help accountants value assets at their current market cost. Level 1 compares assets to identical products in the market. Level 2 compares assets to closing market prices of similar products, and Level 3 requires a company's own discretion and individual data and observations to value an asset. The changes from the previous guidance to the new guidance include the distinction between a non-financial and financial asset and requires entities to disclose quantitative information that is used to value Level 3 assets. For revenue recognition, revenue is one of the most common items on the financial statements that financial users look at to make decisions regarding capital allocation, which is why it's so important to remove inconsistencies and weaknesses in the official guidance. Previously, there was no clear process for recognizing revenue from contracts with customers. Under the new guidance, there are 5 steps for recognizing revenue from contracts. These include identifying the contract, identifying all performance obligations in the contract, determining the transaction price, allocating the transaction price, and recognizing revenue when the entity satisfies the obligations. The change from the previous guidance to the new guidance include a reduction to the number of requirements for recognizing revenue, because previously accountants had to recognize revenue based on the type of transaction, or only when the revenue is realized. The new guidance also has disclosure requirements tailored to external users to better understand the nature, amount, and timing of the revenue being recognized. The social impact of Convergence has a social pedagogy that exists between external users of financial information and the businesses producing the information. As previously mentioned, the Convergence project has been geared towards achieving a universal set of accounting standards that will be used across domestic and foreign companies. By working towards Convergence, the FASB and IASB are restoring investor confidence in the accounting industry. External users of financial information can rely on the information presented in the financial statements to be faithfully represented as outlined in the conceptual framework. With the implementation of the new fair value and revenue recognition guidance, investors and creditors can better understand how revenue is generated and how assets are being valued. In conclusion, the Convergence project of GAAP and IFRS has posed significant challenges in both accounting theory and practice. Transitioning from a rules-based system to a principles-based system is difficult for some companies because it requires them to reevaluate their existing practices and refine them. The full impact of Convergence on the financial accounting industry in the U.S. remains in question, as the social, political, and economic pieces all contain multiple moving parts for implementation of new policies. Further research might include reviewing the responsibilities of the FASB and the IASB to determine who would be the overarching authority for enforcing a universal set of accounting standards. In the United States, companies are bound by the Securities and Exchange Commission to file financial statements in accordance to GAAP. The SEC oversees the FASB in enforcing accounting standards. Full convergence would require one overarching authority of all domestic and foreign companies. In the coming years, it will be interesting to see what changes are implemented in the accounting profession and how they manifest into both theory and practice. Here are my references for my research today. Thank you for taking the time to listen to me.